Welcome our next guest on the show, and he's someone who spent a lot of time in the Indian capital markets. In his earlier avatar, he was with one of the better-known AMCs. He was with Birla Sun Life Mutual Fund for a long time, heading fixed income. And in his new avatar, I think since 2021, our guest has been the founder and the head of Macro Mosaic Investing and Research. I'm talking about Maneesh Dangi, very, very well-known in the Indian bond market circles and fixed income investing circles, and now also, of course, looking at equity investing. Manish, welcome to the show. It's great to have you on, and good to see you here. I know you were always a recluse back in your, fixed income avatar, so we're very happy that you can take out some time. And good time to have you on when the headline, you already know my first question, is that 4.88% on the US 10-year yield. Welcome to the show, and tell us what you think about all that's going on.
Hi, Survi. So all that going on is a meta question. And frankly, I don't know which way to drive the answer. But yeah, I mean, purely from a market standpoint, I guess the which way the camel would sort of settle or sit is with respect to US recession or with respect to US monetary policy. There's a significant divergence between fiscal and monetary policy in US. And because, as a matter of fact, fiscal policies continues to stay too loose, and therefore monetary policy has to sort of tighten significantly more than contractually it could have been, and that's sort of starting to trouble all sorts of markets and should trouble emerging markets, including India. So that's the core of many other things that's happening in the world.
Sure. Maneesh, you've watched these markets for so long, whatever happens in bonds and fixed income, and at times it's far more sort of confounding than what equities can do. The answer that we're getting from most of the guests we interview here is that higher for longer and the pace of the rise could lead to some accidents. And no one really knows what kind of accidents, what the future could really bring. So can you crystal ball gaze for us and tell us if this is something really to be worried about?
That's true. I mean, see, as a matter of fact, U.S. Monetary policy is as tight as it is today because that economy is doing pretty fine. But because we live in one world and dollar is, in some sense, global currency, U.S. rates, in some sense, is global rates. And since they are tightening for the local reasons, globally, it's very unlikely that countries like Europe, even most emerging markets, would be able to accommodate it. So it's very, very likely that, as we saw in the last 12, 18 months, many accidents in Europe, in some of the emerging markets, that would continue to happen. That's my base case. Would the U.S. economy roll over at some point in time or U.S. recession ensue? It'll be actually a relief for most of us. Until then, it's actually a sort of an alarming time for most emerging markets. Now, what would be an accident next? I think you got to spot it somewhere either in Europe or Asia, because these economies, especially let's say in China, the balance sheet is pretty stretched. Some of the Asian economies are already under duress. Europe has been actually struggling for 5-7 months because of high energy prices and, of course, tight dollar. So some of these places, you will have significant stress coming in for next couple of months.
So an accident is possible in Europe and China, but perhaps not in the United States, right? According to you right now. And will it derail the markets if we do get one?
It is the cleanest shirt, and to that extent, it's in the. Everyone is in the queue, but it's perhaps towards the end. Whereas, we have to understand the balance sheets in US, both private balance sheets, which is household as well as corporate, are pretty clean. That's not true for many other economies, and which is why accidents, when we call them accidents, it's not income-driven recession; it's actually balance sheet busts. And that's not likely to happen in the US. It's more likely to happen outside of US.
And if it does happen in Europe or China in the next 6 to 12 months, how much will it hurt equity markets globally and particularly in India?
It would, right? Let's take a step back. Essentially, it's important to understand that since GFC, most crises in the world be it Europe, US, or in India. Let's say even in India, 2015 and 2018 were balance sheet driven crises, where basically tight rates led to some of the balance sheets, sort of go through this revulsion because they couldn't sort of tolerate such high interest rates or tight dollar. That's been the way the template of sort of stress has played out in the world. But in this cycle, given, let's say, both India and US, balance sheets are relatively clean. Even in India, household balance sheets are fine. Your corporate balance sheets are not too stressed. Most of the corporate balance sheets are not too stressed, and which is why the stress is going to be income driven. Eventually, high interest rates, high crude, all of that would sort of eat into the consuming power of our retail household, and that would lead to slowdown. So it's an income slowdown versus a balance sheet bust, So that sort of is the way this cycle is playing out as we speak.
But, mortgage rates are at 30-year highs in the United States. It's at 7.8%, will not, the household balance sheet, which up until now is resilient, there is enough buffer. Will not the high interest rates start hurting? Can this not turn into a credit cycle, for instance, a credit risk instance, a mortgage risk?
So look, mortgage rate, just imagine, if you had taken a loan from ICICI Bank or SDFC and at 6.5% or 7%, and even though interest rates are rising, it doesn't matter because they were fixed rate loans. So, it so happens that in US, the average household who had borrowed in mortgage for 25, 30 years is at 3.5%, and that's not getting reset. So that's unique to that country, that majority of mortgages are fixed rate and therefore are insensitive to high interest rates. So again, you ought to understand the difference between balance sheet or income. So balance sheet stress would have been there had it been, let's say, in India, where interest rates had risen as much. That would have led to much more sort of EMIs because interest rates would have gotten repriced the mortgages. But that's not happened in US because mortgages are at fixed rate. That's not true again for Europe because their majority are variable rates and they are getting repriced, and which is why household, if at all they're going to be stressed, is going to be in Europe, not in US.
Fair point, Maneesh. I mean, I'm just going back to all those ugly learning lessons of 2007-8, very early part of my career. And that's because house prices started to fall. And that's why mortgage-backed securities and the way that mess unraveled, it wasn't so much because of high rates. Point well taken. But okay, let's now, make sense of what this could mean for the Indian equity market and how someone should be looking at their equity portfolio here in India. What's your sense when banks have not done well, IT has been kind of stuttering along, and this has been an entirely capex-driven rally, something which is very unusual for this market. What would you advise for, say, the next 6 months or longer?
So I made this argument over the last 2 years that Indian market had become expensive and risk premium there. Even back in Diwali of 2021, I made this argument to Tata and many others that there is little risk premium available. Unfortunately, even though there's been listless 2 years, markets have barely gone up in dollar terms, actually have not returned any risk premium over the last 2 years versus bonds. The setup hasn't changed. Markets are moderately expensive in India. At the current level of ROEs, it's unlikely that the EPS would grow at more than 9-10% over the next 5-10 years. And that means, the risk premium available in India is still, less than 3%. Now, investors who've come in last 5 years or have seen last 10-20 years are spoiled for a good 5-7% risk premium over bonds, and that's not available anymore. So I think, people have dialed in for disappointment. There is not going to be a major drawdown in markets unless, of course, the exteriors or the external environment change dramatically. But then there's going to be disappointment in terms of the risk premium that you will get in bonds. So that's one way to look at it. Of course, the other is, of course, earning trajectory itself. So far, last 2 years, earnings have kept pace. But then because nominal GDP is likely to roll over, it's unlikely that earnings would actually grow at more than 8-10%, even in near term, versus endless expectations of 15-16% CAGR over the next 2-3 years. So again, there's going to be disappointment. And finally, as a matter of fact, when US yields are at 5% and above, most global money would rather flock to, those sorts of carry yield or cash yield instead of dialing in any sort of risk anywhere else. And to that extent, there is a risk on FI money coming in India. So it's sort of a potpourri of all sorts of things which would not drive markets crazy on the downside, but then, there's going to be little risk premium for bonds or over bonds in equities.
Okay, so Rima, hearing Maneesh, I think the advice that I'll take is I'm not going to break any FDs to invest in the equity market if I go by the kind of risks that he's describing.
Yeah.
All right, Maneesh. Thank you very much. A pleasure having you on the show, and we hope that we'll hear more from you in the weeks and months ahead. Have a good day. With that, we need to take a very, very quick break. We'll come back with more on the other side. We also